Good morning again. You don't see my name on here. I hopped on in front of Paul because I wanted to make a few comments about the pre-application process. You can't imagine how hard these guys have been working to improve the pre-application process. A couple of weeks ago, we had a continuation of our lean streamlining. Some of you participated in that, and we really appreciate your help there. We're trying to get it down to the core issues, trying to make it as easy for you, the clients, the hospital, as we possibly can. So that's one thing. The second thing is, if we back up in time, one of the reasons that we started the pre-application process was to be helpful to you guys and to be helpful to the hospitals. We thought, as was being pointed out, that if we can hit the key issues right at the front end to see if they qualify, even if the hospital qualifies, it'll save a lot of time. And actually, it has done that. I would like to point out that this is a courtesy. It's a courtesy. There's no fees. You know that. There's no fees. These guys spend a lot of time going through all the papers that are submitted, trying to come down to identifying the key issues, so forth and so on. But they do that as a courtesy to, so that it saves the hospitals money, saves you time and energy. The other thing I wanted to mention was I always think it's good to get together eyeball to eyeball. So we meet and greet, as Paul said, we get to know each other a little bit better. The hospital folks see that we don't have green eye shades and thick glasses and things like that. We're real human beings that we're trying to make the deals work. We will have suggestions how to make it work. We will be honest and say the things that we're having a tough time with. But eyeball to eyeball, it gets around to the question about venue. We have said, maybe about 5 years ago, we said, hey, we have all this new technique now. We can now do, like we're doing right now, webinars, but we can do so-called webinars with the hospitals who are out in California. So you don't have to fly in here. That is still on the table. It's an optional thing that can be done. We can do conference calls. I don't think that's as effective, but we're willing to do it. So don't feel an obligation to come out to shake hands with us. Tell your clients that if they really want to, they can work things out with this group, and we'll make arrangements and we'll do it long distance if that's helpful. Because now it's expensive to fly, to stay overnight. It's expensive in terms of time. So it's an optional thing that I just wanted to point out to you. Paul? You're next.
Yep.
Okay.
Thanks, Roger.
Sure.
Okay. So we're going to turn now to our program where we're going to discuss a little bit about the eligibility requirements of the program for 242 and 223F. There are definitely a number of basic regulatory requirements that the program requires hospitals to meet in order to qualify, along with some requirements that apply to new construction or major renovations at hospitals, or for the refinancing of existing debt. Some debt can be included, others cannot. All of the requirements that we have, they're complex. It might appear a little bit daunting at first, but a lot of it just comes down to common sense on all of our parts to say, okay, what makes sense to include, what doesn't. I think once we have a presentation such as this and give Paul a chance to explain it to you, as well as have you look into our handbook and our guidelines, it'll begin to really make sense to you. Again, as a lender, it seems a little bit daunting at first, but again, I think Paul's going to walk you through some of these and it'll make more sense to you. So, Paul, if you would, please. Thank you.
Okay, thank you, Jeff. So this section of the presentation is on eligibility requirements, and for the most part, again, as with the process, 242 eligibility requirements are similar to what we have in the 223F program. So I'll start with a basic overview. There are basics of the program, get into statutory requirements. There are a few of those. Kelly touched on them this morning. And regulatory requirements. And the regulation is where you'll see the primary differences in the two programs. 242.16 is the regulatory reference, if you're interested. There's a few very interesting pieces in there. So, but first, some program basics, and we touched on some of these this morning. Uses of loans, anywhere from construction, 100% construction through 100% refi, subject to what Kelly talked about this morning with the definitions of capital debt, hard costs and soft costs, et cetera. FHA insures 99% of the loan amount, 25-year term maximum. Occasionally there are requests for shorter terms with the construction projects. Generally they are 25 years. I think we've, though, had a couple in the last 2 years, deals that included a large refinancing component that actually have shorter terms. So that option is there for hospitals. Maybe some of them are a little bit more conservative than others and want to keep the term short rather than stretching out the debt. But that's up to the hospital. Advise your hospitals as such. But it's something that could be a good thing for some of the folks out there. Fixed annual premiums, we're talking about the mortgage insurance premium. There are other fees associated with initiating an application, but ongoing fixed mortgage insurance premiums vary between 0.55% and 70 basis points of the remaining mortgage balance, and that's depending on the program. So, the refi programs are generally on the low end of that. 242 and 241 are on the higher end. Getting into the statutory requirements, we've touched on a couple of these earlier. They include some of the following: the loan-to-value requirement. I'm sure most folks are familiar with this. The maximum loan-to-value is 90%. The loan-to-value calculation is listed here. This might make a little bit more sense when JB goes over the 2013. These are line items in the 2013. Total estimated replacement cost is our estimate of the value of the project. It includes net property, plant, and equipment that's going to be used as collateral for the mortgage, as well as the hard costs and soft costs associated with the project. Another thing that we'll be going over in the panel, there are some, even though it's a statutory requirement, there are some accommodations here. If the true value of the hospital's property, plant, and equipment isn't enough to get down to a 90% loan to value, we do allow, in certain circumstances, an appraisal to be used to say what the true value is, so that can be used for loan to value purposes, and that's going to be a panel discussion item as well after this session. Also, statutory requirements, first lien, of course, on real estate. Also part of collateral is equipment, accounts receivable, personality, et cetera. Our statute says, or at least the preamble says, that Section 242 was designed for urgently needed hospitals. And this has been subject of a lot of discussion internally and also in the industry. Within the regulation, we discuss how HUD is interpreting this. And also in the applicant's guide, we spell out a little bit more how we're interpreting this. Essentially, we do a market need review for each deal that comes in. It requires that the lender fill out in what we call an applicant data request, and that's an Excel spreadsheet located on our website. With a preliminary review, the hospital fills that out. It's, I don't think it takes a whole lot of time to fill out. It's mostly information about the project. We ask the hospital to break down their patient days for the most recent fiscal year into different categories, one of which is breaking it down by zip code. And the purpose of this is that so that HUD can understand what the hospital service area is. The lenders are asked to list what the competitors are and where those are located in this Excel spreadsheet they send to us. And HUD takes that information, uses some of our internal models to determine, essentially, in a nutshell, whether the area is overbedded or not. And if HUD determines that the area is already very much adequately served, it could potentially put the project, at least as HUD is concerned, in question. This sounds a little bit scary, I think, and there's been, like I said, a lot of discussion with the lending community about how HUD interprets this model that we use, and and why we even do this in the first place. But the fact of the matter is, and I said this a couple times during these lean sessions we've been having recently, HUD, it's very rare that we turn down a deal for an existing hospital for market need reasons. Very rare. I can only think of one since I've been here, and that's 10 years. So it's very rare. The deals that it usually hangs up where we have a problem with market need are the startup facilities. I think most people would agree that most communities in the United States don't have a terrible, don't have hospitals nearby or aren't adequately served. So, while we do take this very seriously and we do spend a lot of time on this model, and the hospital have to spend a little bit of time submitting the information, preparing and submitting the information to us, the fact of the matter is we don't turn a lot of existing hospitals down for this requirement. So, I think it's very important that we do this. It provides us with a lot of interesting information. So just, understand that this is an important piece of the preliminary review process, and it ties back to both the regulation and the statute, and that's probably the biggest reason why we do it. Patient day requirement is the other requirement in the statute. The program's designed for acute care hospitals, and the statute, although it's fairly old and dated, it does give guidance on how we determine whether a hospital is acute care or not. Essentially, qualifying hospitals have at least 50% of the patient days attributable to acute care, and non-acute care patient days include some of what you'd expect: skilled nursing, acute rehab, psych, other services, and there are some others listed in the statute. Now, what I normally tell folks is that if, say, you have a critical access hospital that operates a nursing home, a skilled nursing component, usually that's what hangs up facilities. The average hospital will meet this requirement without much trouble. And even if they don't, we do have an adjustment, an accommodation in the handbook, which can be used to help hospitals meet this. In the event that they're right on the borderline, but when you calculate the patient day rule, we can adjust based on revenues. And what this does is take into account the fact that the hospital provides a lot of acute outpatient work, but since those aren't reflected in patient days, it's a way to help hospitals qualify. And every once in a while, we get one of those in-house. But like I said, there's a very specific calculation, an adjustment that guides you how to do that. That's in the handbook. It's a supplement to the handbook, just like the applicant's guide is a supplement. I think Blow said there were 8 of them. So check out that if you have a hospital right on the borderline. Now moving into regulatory requirements. HUD has, we look at a lot of different financial ratios during underwriting, but there are 2 ratios that are particularly important. They're requirements within the regulation, and that's the operating margin and debt service coverage. For the operating margin, we require that looking back at the last 3 years of audited financial statements, we calculate whether or not that operating margin is positive. And I guess the easiest way to do this is to just look back at the operating income from the last 3 audited fiscal years, and add those up, if that number is positive, then good chance that's going to qualify for this. I guess the only caveat is that calculating operating margin and determining what's operating income in some cases is subject to some discussion. The hospital in its statements or you as lenders might calculate it a little bit differently than we do. So, if you have a hospital right on the borderline, as far as the operating margin is concerned, I recommend you talk to us. Generally speaking, and what I'm talking about is whether certain sources of income are operating or non-operating. Generally speaking, if it's investment income, contributions, we'll take that out of operating income and not include that in the operating margin component, but it's in debt service coverage. And sometimes, depending on the hospitals and their auditors, they'll classify that different ways. So make sure you pay close attention to what the audit and where those line items are, and back those 2 out when you do this calculation. Also, operating margin, we're not looking for an EBITDA, so interest expense, depreciation, those are included in the operating margin calculation. And generally speaking, if the revenue income in question is reliable, if it's recurring, if it's demonstrated to have been that way in the last few years and will continue to be that way, then we'd consider it operating income. Debt service coverage is a little bit less judgment involved with this calculation. It's based on net income or excess of revenues over expenses, whatever's in the financial statements. With both of these, we do have an accommodation, both the operating and debt service coverage, in the event that they don't meet these 2 requirements. There are opportunities to recast the historical results in the event they're refinancing to a low fixed rate through F, or if they've had one bad year in there or have achieved a turnaround, there's some accommodations we can allow hospitals to come in the door, even if they don't meet these few requirements. That's going to be something discussed in a little bit more detail in the panel discussion, I think. But suffice to say, these aren't necessarily hard and fast requirements. There's a little bit of wiggle room there in the event that the hospital is borderline and has some extenuating circumstances. The second one on here, mortgage proceeds used for capital purchases. All we're saying there in general is that if you're refinancing debt that was used for operating purposes like lines of credit are a problem. Mortgage proceeds can't be used to pay operating expenses. We like to look back and ensure that either the mortgage proceeds or the debt used to, the debt that we're refinancing was originally used for capital purchases, and that goes to the capital debt definition that Kelly mentioned this morning. Refinancing limits, of course, for 242 has to be at least 20% construction. For F, it's the opposite. No pickup projects means we can't insure a deal for a construction project that's already started due to Davis-Bacon rules. And lastly, debt may not be refinanced unless the construction project associated with that debt was completed more than 2 years prior to application. Other regulatory requirements, owner-operator structures aren't allowed, and this is quite different from the 232 program. I guess there's a few different reasons for that. You know, our legal documents, covenants, regulatory agreement aren't designed for that purpose. There's a certain level of discomfort, I think, within the 242 program for doing these kind of deals. You know, maybe in the future we'll find a way to get a little bit more comfortable with this structure, but you know, for the time being, owner-operator structures where those are separate entities aren't allowed, and that would require a regulatory waiver in order to consider those types of deals. The fully functioning hospital requirement is something I touched on this morning when I talked about carve-outs. The basis for this, and you know, I could have arguments with this with industry, but I'd point to 242.35 and the regulation as a basis for this. That section says that the mortgage should be on all the all the real estate, et cetera, used in the operation of the entire hospital. So generally speaking, all the assets needed to operate the hospital should be included as collateral. There are some exceptions to this, of course. What question is what can be excluded typically in the deal? Generally foundations, if the hospital operates a foundation, you know, that's important to the hospital, but not something we generally require to be included as collateral. Properties with environmental problems or big environmental challenges are generally included or excluded. Some hospitals own housing, not very often, but if they do, that's generally excluded. And I guess the one key point here is if the hospital wants to carve something out that we might consider important, we need to have a discussion about it as soon as we can, even in the preliminary review or pre-application phase. I understand that this is has been the ability to, say, carve out a piece of property has been an attractive feature, say, for the 242 program, and we're willing to talk about it, certainly. I gave the example this morning of the hospital that wanted to leave something out of collateral because it was going to be, there was another use for it, or either sold or demolished or something. In those cases, and in those cases, we're willing to talk about it, certainly. And you know, in a lot of cases, we can work something out. Also, a regulatory requirement, and all of these, in one way or another, the statutory regulatory requirements are dealt with in what I referenced this morning, the preliminary review templates. Each of these questions are discussed in one way or another in that template. So as you work on the preliminary reviews, you know, make sure you review that document in detail. One of the questions is compliance with state and federal regulations. If there's a investigation ongoing, and generally you could figure out if there's an investigation by reading the financial statements. It'll be disclosed in there. If there's an investigation ongoing, and you know, we need some sort of evidence to determine that the downside to that investigation isn't so big that it will threaten the credit quality of the organization. We understand that it's normal course of business to have these sorts of things happen. We don't want to turn down deals because they have this sort of issue. We want to talk to the lender and work it out, but it's still something that we look at because it's a regulatory, important regulatory requirement. When it comes to regulation, statutory criteria, what's different in 223F? Of course, there's a limit on construction. Hard costs, if any, may be for equipment only. That's an important point. And it also goes for 241 deals. 241 deals can have, just be equipment. I don't expect that to happen often, but it's allowed. Debt service coverage ratio requirement is different for 223F. We require a 1.4 debt service coverage when looking at the last 3 fiscal years. And to some extent, it reflects a regulatory desire, I'll call it, for a 1.4 coverage post-project in 242. When we review the underwriting for 242 deals, we like to look out to the out year after the project's complete, and we'd like to see a 1.4 times debt service coverage. So in some ways, it makes sense that you'd have we'd like to see the same in the refinancing. Once the refinancing is done, with the recast if necessary, the minimum is 1.4 debt service coverage. Probably the most significant difference between 242 and 223F is the threshold requirements in 223F. And this is discussed in 242.16 of the regulation. This first one, though, I think it's a little bit more straightforward. So the threshold requirements are there to help ensure that the hospital applying for 223F really needs this refinancing, and the first requirement is that the hospital provides an essential healthcare service. And how does the lender demonstrate that this is met? It seems like a reasonable requirement. So after a lot of thought, what we decided was, well, the hospital is submitting an applicant data request and HUD is doing a market need model. Well, it goes to show it's reasonable to assume that if the hospital is a needed facility, then it must provide at least one essential healthcare service. So lenders, frankly, you don't need to worry too much about this. Just submit the applicant data request as you always would. HUD will use that data to determine whether or not this criteria is met. And as I said, most deals, unless they're startup facilities, which have a little bit harder time, most deals will pass the market need test and pass this requirement. The remainder of the requirements were also subject of much discussion as we wrote the handbook, and I'll apologize to my cohorts over here. I'm going to ask them to flip ahead a couple slides to, I think it's 54, to the background. Yeah. When this originally was published back in 9 and 10, we heard a lot from lenders about how we're interpreting these. How is HUD looking at these threshold requirements? What are we requiring? Hospitals, lenders weren't sure what they needed to submit to us. So as a result, it was sort of all over the map. So what we did in the handbook and the applicant's guide is to say, well, we understand that we need to provide a lot of clarity behind this. We understand there's a lot of questions. Let's, write up something that everyone will understand, and it'll all be clear about what needs to be done in order to meet these qualifications. So first of all, what we're asking for is that the hospital provide certifications, or that the lender provide certifications, I'm sorry. And this is a slight departure from how we've done things in the past. Generally, you submit information and HUD reviews and determines whether a certain requirement is met. We sort of flipped the switch here and decided that a lot of these threshold requirements are things that the lender knows better than HUD. And we don't necessarily want to, at least in this case, substitute our judgment for something that you should know better than us. And this will become more clear in the next slides, but essentially, how do the certifications work? They're submitted at the preliminary review phase. Again, this is only for 223Fs. They're detailed in the applicant's guide, and they're part of a supplement to the preliminary review templates for 223F. And at a minimum, the lender would submit 4 of these to us, 4 certifications, along with the more detailed, broader 223F template. Upon receipt of the certification, we do review it. There will be documentation that you'll include to help us review it. But we won't be looking forward to, we won't be looking to second guess what the lender has given us in the event that it's a question of professional judgment. You know, I think we'll be do our best to take the lender's judgment on that. But again, it's important to go through as a regulatory requirement. Getting into the meat of it, the most significant threshold requirement is the 3 of 7 criteria. So in order to qualify for a 223F, and we look at this at the preliminary review phase, in order to qualify, the hospital must meet 3 of 7 criteria. And 3 of 7 criteria that demonstrate or help demonstrate that the hospital's performance would be materially improved by doing this refinancing. The 3 of 7 criteria are listed on this slide and the next. It's a mix of quantitative, other factors that involve judgment, but you know, without going through each of these in detail, I'll mention some common threads, but a lot of them are fairly self-explanatory. Where they're not, we've provided guidance in the preliminary review template supplement that describes a little bit more of what we're looking for. Certainly, if you got a deal cooking and you have a question about whether or not you think the hospital meets these requirements, give us a call. We could provide some comfort that may be needed to put your name on a certification form. Just so I say that we're willing to help. We don't want these criteria to become an undue barrier to getting good deals in the door. And I think we've tried to do that and try to be very clear and try to do that as part of the handbook and the applicant's guide. So. So the common thread I'd say is that we've provided some accommodations in these 7 criteria for hospitals that are seeking to refinance variable debt into fixed rate debt. If you read the requirements, the criterion literally, they don't appear to allow that. You know, it appears to exclude to a large degree hospitals that want to refinance into the safety of a fixed rate debt. So an example of this accommodation is in number 1. Criterion 1 is the proposed refinancing would reduce the hospital's total operating expenses by at least 0.25%. Taken at face value, it appears to exclude deals, but the accommodation we've given is in the event that the hospital is refinancing from a variable rate, the lender can recast interest expense, take into account future changes in rates to arrive at an average. We know that hospitals, when they make a decision to refinance, they're looking at a longer time horizon. They're not just looking at how this is going to impact them next year. They're looking at the next 25 years. So, I thought it was necessary to include this accommodation for those hospitals that have that case. And the accommodation is also allowed in criterion 7. Another common thread that goes through these certifications. The lender needs to consider all debt to be refinanced. Example number 4, hospital's annual total debt service is in excess of 3.4% of total operating revenues. Again, what we've decided when writing the regulation is that a hospital needs to refinance if its annual debt service to operating revenues is high. So that's how we came up with this one. But the lender needs to consider each of the pieces of debt that they're planning on to refinance. So the lender must base the calculation of annual total debt service on all the proposed mortgagor's long-term debt during the last 3 fiscal years. And this is guidance given in criterion number 4 and also the first one. Supporting documentation is required for each of these certifications. That's regulatory language. We don't, we would like to see how the lender did or calculate, how they did the calculations, what information they're relying on in order to do that. An example is number 5, the hospital has experienced a withdrawal or expiration of its credit enhancement facility, or the lender providing the facility has been downgraded, etc. In order to meet the criterion, the lender must provide documentation showing that one of these events has occurred or is imminent. Documentation will differ case by case. Again, it's up to the lender to determine what information is sufficient documentation and provide that to HUD. For the quantitative criteria, it's probably a little bit easier. You'll just need to give your calculations, and hopefully those will tie to the audit that you're basing them on. But again, it's up to the lender to determine what is submitted with these certifications. Another common thread, HUD is depending on the lender. Again, the best example I think is number 6. The hospital is party to covenants on its existing financing that are substantially more restrictive than the Section 242 mortgage covenants. Again, lender is in the best position to determine, lender and hospital are in the best position to determine whether or not the covenants that they are involved with now are more or less restrictive than the 242 covenants. So this is a particularly good example of where the lender is in a better position to determine whether or not they meet this criteria. And finally, flexibility and clarity. There were a lot of questions about what we'd allow a few years ago for the criterion 7, which is sort of a catch-all. There are other circumstances that demonstrate that the hospital's financial performance would be materially improved. We got all sorts of rationale for that one. So we figured it could use a clarification. And provided within that certification, you'll see it if you read it, are specific circumstances that the lender can rely on when signing this. If the operating margin is impacted by a certain degree, operating income is impacted by a certain degree, and also if they're refinancing variable to fixed, where that's enough to meet this requirement. So overall, I think for new lenders, this is a little bit hard to absorb. These criteria are a little bit confusing. I hope though if you have a deal cooking, then you'll read these over and find out that they're not so bad. There was a lot of questions, as I mentioned a few years ago, and a lot of problems at HUD trying to figure out how we were going to interpret these. We turned down a lot of deals, unfortunately, a few years ago, and I'm sure a lot of it was because of some of the confusion behind these. So I'm hoping we're going to have a better experience as far as getting deals in the door, and this should be one way that helps that happen. So, all right, thank you. Thank you very much.
Thanks, Paul. Just a word about Paul's world. He and his group work extremely hard on trying to make a very daunting process as easy as possible. As you can see, some of the new lenders in the room, there's a lot of criteria involved. There's a lot of detail involved. There's a lot of heavy lifting involved on HUD's side to try and really qualify these transactions. And we work very hard to give every transaction every opportunity to meet criteria and to talk with you about what these criteria are, what flexibility we have with them. So clearly, we're in your camp. We want to do these transactions with you. If we come up and bump up against some very tight areas, we're willing to talk our way through those with you. So again, HUD's doors are wide open, and we hope you bring more opportunities our way. With that, we're going to now assemble a panel discussion, and I'd like to ask the panelists if they could come up today. Today, we're going to have a brief discussion with Bill Williams, John Whitehead, J.B. Nathan, Kelly Gill, and Nate Dean. So give me a minute to assemble that team. Just a moment. Got your spots? Okay. Well, we are making progress through our program today, but really we're just getting started. You know, Paul really touched on a lot of general areas that are the regulatory and statutory requirements of the underwriting side, but I think we're going to have to go a little bit deeper into the details of some of those areas to make this a little clearer for you. As Paul mentioned, there are a number of factors that HUD takes into consideration when assessing the need and the ability for us to grant mortgage insurance. As he noted, market need, debt service coverage, operating margins, financial feasibility studies, there are premiums, there are fees, there are equity requirements, there's projected interest savings. There's a lot of information there that Paul just delivered to you. We, also being the government, have a whole lot of nifty forms for you to fill out as well. And so to address some of this, we've gathered a panel today who are going to basically review how HUD looks at these areas of interest and hopefully provide you a bit of clarity. Once again, I'd like to introduce Bill Williams, John Whitehead, J.B. Nathan, Kelly Gill, and Nate Dean. Thank you, team.
I'll start off with the interest expense recasting. First of all, I'd like to say we just want you to bring us good deals, okay? And that's getting harder to do. We know that. There are several subject matter experts in our group that knows that as well as anybody. But on the recasting of interest expense, one of the 3 of 7 criteria is that obviously the interest expense is better in terms of the new deal. So we want to look at that. But you know, if you meet the interest, or if you meet the operating margin requirement and the debt service coverage ratio requirement right off, then there's not a whole lot of reason to go into a lot of paperwork in terms of looking at a recast and that kind of thing. So if you meet the requirements, you meet the requirements, and that gets back to the bring us good deals. But there are going to be hospitals in this 223F arena, absolutely, that will require a recast of interest expense because they have an egregious debt deal now. The one 223F that we did several years ago that JB and I worked on, they had an interest rate between 15 and 20% out in California. And I said they could have gotten a better deal from the mafia out there. Just kidding. But we're going to see some egregious deals and in this 223F arena, but we're also going to see some deals that have maybe 4, 5, 6% interest, and they have a swap that's been killing them the last few years, and maybe that's changing, right? If interest rates go up, maybe that changes. But we will recast the interest expense. That is trying to do an apples-to-apples comparison, and JB and I, again, have had some discussion about that. It's not quite as simple as it seems. Because you may have fixed and variable debt mixed, you may have 2 or 3 elements there that you have to recast, not just a pure interest rate to interest rate apples to apples comparison. So my advice there is call us. Call Paul, call myself, JB, or 1 or 2 of the other people that have been around a while, and we'll work through that with you in advance of you sending us that preliminary book. The other really important thing that I wanted to talk about is go back to your old finance book that you had in graduate school where it talks about weighted average cost of capital, delete the cost of equity, and that's basically what we want to see on a recast where you have mixed elements, fixed and variable and so forth. And of course, we'll have for-profit and nonprofit hospitals in this mix. So we may have some for-profit hospitals that have a half a dozen different debt pieces out there. So it gets a little bit more difficult, when you get away from just the refinance of a tax-exempt bond issue that has a 4% rate for 30 years or whatever it is. Also want to mention that swap cost is not interest cost. That is not included in this apples-to-apples comparison. We understand that cost. We understand it's out there. And therein is the reason that we said if you have a particularly bad year with swap cost or something else, we can throw out that year. When we want to look at 3 audited years, but we'll throw out one of those years if there's a particularly bad year with swap cost or some other specific reason like that. And then the next slide that I want to talk about is turnaround. The reason I link this right up against this recast of interest expense is not that it's a new category. We look at turnaround situations and have looked at turnaround situations over the years. The difference for 223F is, okay, if we look at an interest rate recast and they're still negative, then we'll look at the turnaround situation. Okay, we'll say, okay, look, they're obviously in a turnaround situation, so we've got to have another year audited financials, and you got to meet the requirements. And if you need another year after that, maybe it's 2 years that we need. By commitment time on a deal, we need 2 years of audited financials that meet the requirements. So that being said, in a turnaround situation, obviously we want to see at least a 1.40 debt service coverage ratio and the operating margin being break even or better. I don't like that 0. I like to say it's break even or better because that's really what we're after from an operation standpoint, including or excluding those operating income and expense items that are necessary to arrive at a good number. Okay, I think that's enough of that. You may have some more specific questions late at the end of the day in our Q&A session, and we'd be glad to answer any detailed questions you have.
The next topic is the study of market need and financial feasibility. For Section 242 applications, the regulations have always required that a study of market need and financial feasibility be included in the application. And there's a reason for that. The study presents assumptions and assumptions about utilization, revenues, and expenses, and presents a financial forecast that's based on those assumptions. In the case of a big construction project, there are a lot of unknowns, there are a lot of assumptions that have to be made. And it's for that reason that we have always required that study, and we've required it to be, although management may originate the forecast, to be prepared by a CPA firm acceptable to HUD. And you can see in the applicant's guide what that acceptable to HUD requires. And so in that case, there's significant changes in the nature of the hospital's business, and that's why we want that study every time. And incidentally, in the past, we have also just sort of reflexively required the study for Section 241 supplemental loans, although that was not always based on a real need for the study. So things are changing. Next slide. Okay, in the regulations in the handbook for 223F refis for 241 supplemental loans and for 223A7 refis. We have a little something different. HUD determines if the study in those cases has to address market need, and that's determination is going to be based on the response to the applicant data request that you send in, and other information that HUD will have concerning the market area. And certainly in the case of a 223F and a 241, well, not a 223F, a 241 and a 223A7, HUD's been dealing with that hospital for years. We have a pretty good handle on the market and the situation. And so we'll make a decision of whether there has to be a study of market need in those cases. And we'll also be making a decision on whether a CPA firm has to be engaged in a study. As a general rule, the bigger the project in a 241, the more likely that CPA involvement is going to be needed because there's more assumptions. And the greater the limited rehabilitation in a 223F or an A7, again, the more likely the CPA is going to be needed because there are assumptions out there. But I think you'll find that in many of the cases, HUD will decide that that the time and expense involved in that study is not going to be required, and that should make you all happy and make the hospitals happy. What's the next one?
Premiums and fees. I get the privilege of talking about money. So I'd just say send it in and we won't have any problem. Now, as you know, that there was a new notice that was put out, I want to say last August. It did change the fees in here. So for 223A7s, the MIP is 55 basis points, but it's 50 basis points for the first year. In there, it's 55 basis points thereafter. The new rate for 223F and 241 is 65 basis points, and for 242s it's 70 basis points. But for the 223F, 241, and 242 loans, it's 1% for the first year. And a lot of us had internal discussions on this, so we generated a lot in here. And Section 207 Part B is actually part of the 242 reg, and so if you go back to 207 Part B, and I want to say .252, there it states for the first year it's 1%. So you basically have a 100 basis points for the first year in terms of the fee. So now, Kelly, you're looking at me on this one.
Weird. I don't know if your reference was quite right, but we can move on.
Okay, we'll move on. We'll check that out, and we'll
Not
get.
the fee basis, just the reference.
Oh,
to
the
207.
reference I may not. I'll tell you right now. The reference.
Okay.
I'd have to look that up to be exactly sure. Then, if we'll move on to the next slide in here. We got the premiums and fees in there, and basically what we have is we've got an inspection fee. On every deal, we do ask the Office of Architecture and Engineers to go out and look at the deal in here. You say, well, we don't have a construction project, so why do they need to look at that? Well, if there was a leak over the OR, that could affect the ability of the hospital to pay the loan. So basically, they're going to be doing some review on any deal that happens in here. The reg says that not less than 10 basis points. So basically, you come in with a 10 basis points for a starting point in there on any deal that we've gotten here. If you go to the next slide in here, then we talk about prorating it, because we say, well, can you be fair on this? And there was a lot of comments, a lot of input from your community, from the lender community with respect to this. And basically, what the new reg came out and basically set it out was that if the hard costs are less than 10% of the mortgage, then it will be 10 basis fee. And then at 5% or greater, but less than 10%, it would be 20 basis points, and then 30 basis points and 40 basis points. And then basically, at the point where you hit 20%, hard costs or greater, it's 50 basis points in there with regard to that. Mortgagee fees, on that one, basically you set your own fees. All HUD does is say that there's a maximum amount in there. And oftentimes you do set the fees at less than the maximum. So all HUD does is check to see it was in there. We did do some things to clarify in there. One of the things you'll notice in the new handbook is we actually use the terms that are in the reg. So you don't have to guess, what's what. So we'll refer to it as the initial service charge, and the initial service charge must be less than or equal to 2% of the loan amount. The permanent financing fee must be less than or equal to 1.5% of the loan amount. However, if you're using bonds, and there's a bond-related transaction, then there could be an additional 2%, bringing that up to 3.5% total on that. So that if you take the 3.5 plus the 2, you're talking about a 5.5% total that can be included in the mortgage on those deals there, or 3.5% is if it's does not involve bonds. And that will be the case if there's Ginnie Maes. On a 223A7 financing, there's another thing that comes in here, and that is the combined permanent financing fee plus the initial service charge is limited to 1.5% in there. We don't care how you divide it, but the total is limited to 1.5%. However, again, if there's a bond-related transaction that goes on there, then it goes up to 3.5%. In some rare cases, you may be using a combination of taxable and non-taxable financing, so you may be using both bonds and, I want to say, Ginnie Maes or something like that in there. In those cases, if you'll take a look at Appendix 4, Supplement 2.6, we tell you, because then a proration comes into play, and that's a little more detailed than we want to go to here, but it's an example in there that tells you exactly how to do the proration.
Next topic is determining the monthly cost savings when refinancing. The regs at 24291 say, with respect to a 223F, that refinancing should be employed to lower the monthly debt service costs. And it says, with respect to a 223A7 refi, the monthly debt service payment for the refinancing mortgage may not exceed the debt service payment charged for the existing mortgage. So basically the same rule applies to both. However, when you get to actually calculating things, there are some questions that come up. Next slide. Yeah. The first point is, and this is something that came in some comments from some of you folks on the regulations when they were going through clearance. If there are new hard costs associated with that 223F or A7, if they're doing some repairs, renovations, what have you, limited rehab, as we call it, below 20%. What we want to do is back out the debt service cost associated with that part of the project and compare apples to apples. what they were paying to begin with, and what they're paying now on the same amount, you know, it's being borrowed. So that's one good thing about the comments we got. Second point is if more than one loan is being refinanced, you need to calculate the monthly cost savings using the weighted average monthly debt service cost of those loans. And if you have any problem figuring out how to do that, call JB. Third point is we're asking for, in the applicant's guide, we're asking for a certification from you that the monthly debt service costs are being lowered, with some explanation of how you arrived at that conclusion. And so, as Paul was saying, in many cases, you all are in a better position than we are to make those determinations. So that's it on monthly cost savings and refis. 241s.
Okay, so 241 supplemental loans. This is something that has been put into the handbook, and I'm going to flip back to the statutory language that this requirement is based on, but the handbook lays out now cash equity requirements for 241s, and it's a 10% cash requirement, must provide 10% of the total estimated project cost in cash as a minimum equity contribution, in addition to meeting all other 242 requirements. And when we say all other requirements under 242, I'd say for the most part, most of the 242 regs will apply to a 241 loan. There may be some cases where they don't, but I'd say the rule of thumb is if it's a 241, assume that the 242 regs apply across the board to a 241 loan. Can we flip back? I'm sorry to do this to you guys. Can you flip back to slide 26, I believe? Sorry. And I think that's just the statutory language for the 241 statute, which shows you what where the 10% cash equity requirement came from. Yes, that's perfect. All right. So this is straight from the statute. A supplemental loan shall be limited to 90% of the amount which the Secretary estimates will be the value of such improvements, additions, and equipment, except such amount when added to the outstanding balance of the mortgage shall not exceed the maximum mortgage amount insurable under the section pursuant to which the mortgage covering such facility is insured. So that's been interpreted as meaning that there needs to be a 10% cash equity requirement for a 241. So, and that's where the handbook requirement has come in, which is straight from what the statutory language. And those are just other requirements, just so you know. 241, maturity date, it has to be acceptable to the Secretary, interest, and it is governed by the labor standards under 212, so Davis-Bacon and what other federal labor standards. A 241 is required to comply with those federal labor standards. I think that's it, unless the program guys have anything to add in. No?
I did go back and check the reg there. That's the nice thing about modern electronics. It is 24207.252, which is subpart B.
Okay.
Posted on the web.
Okay.
Hello, everyone. It's great having these training sessions. It lets us catch up with all of you who we don't see much, and it also lets those of us at headquarters catch up with some of our colleagues from across the country. So it's always a real nice time, and we appreciate you all coming out. I wanted to talk to you about our 223A7 program, about stuff that you cannot read online. we've had a lot of interest in the last 18 months in refinancing our portfolio, and many of that has come through the A7 program. And I want to talk to you all about how to smooth out the application process, because Roger Lukoff and Roger Miller anxiously make themselves available to sign off on commitments. They readjust their schedules to save just a half day in the process, when needed. So we all in the room, lenders and us, need to do a better job of communicating smoothly to get these commitments through the process. So the first thing I recommend is to call Paul Giadrone. And if you can't get a hold of him, call me, and we will help you determine whether or not a 223A7 is appropriate and the best avenue for you to pursue. It might be some other program in OHF, like a 241 maybe. So call Paul, figure out the appropriateness of the application, discuss the scope of what if there is a project, if there are needed repairs, kind of discuss what that might entail, and that can kind of lead to somewhat of a decision tree process about what direction to go. Next slide, please. After that, these last few months we've had some bumps in the road with our processing, and those provide learning opportunities on how to educate you all in advance. Here are some common issues that can take time, and you all can work on these kind of parallel to everything else. The first is filling out the application form accurately, the form 92013. Kind of know ahead of time what allowable costs are, whether or not there are needed repairs to be included, what is mortgageable, what is allowable. Get that filled out correctly. Send us a nice, neat, collated binder form. It just makes it easier and faster for us to review. And if it's faster for us, it's faster for you to get through the process. 2530s, that's an ongoing asset management requirement. In theory, those should be updated, I believe, annually. Sometimes they're not. Just know that those are needed in order to get through the process. So you can start those ahead of time. You don't need to wait for us to remind you. This A7s are new loans. With new loans come new covenants. Get those out to your borrower soon. Start working through and identifying any potential issues that you'll need to negotiate. You can do all those parallel to our credit review process. Just get it going. Figure out whether or not there are any entities affiliated with the hospital that you want to carve out. Traditionally, from a credit perspective, we don't like that. However, it is allowed, but you need to make your case. Figure that out ahead of time. If this, by definition, A7s are with us, the hospital might have what we call after acquired properties. If those are not yet part of our collateral, we'll typically ask you to bring those in. Chances are those are properties that we don't have an environmental review on file. That can take time. Get ahead of that. Construction, sometimes there is a little bit of construction needed, potentially, quote unquote, needed repairs. Again, figure that out ahead of time. How in depth does our Office of Architecture and Engineers need to be involved? These are all things that take time and can add time to the process. To the extent that you can parallel track some of these, it will only serve you and your clients better. That's it. Questions?
Questions for the panel? No? Okay. We're actually going to move right into our next panel discussion here. Oh, yeah, please, Rod. Go ahead.
On the 241 equity requirement, that's a new interpretation of the Act that conflicts with HUD's past guidance in the 232 program, how it's sized. So I'm just wondering, why are we changing that now? It's inconsistent with the applicant's guide on sizing, and quite frankly, what's the benefit that HUD's looking at to force their hospitals to spend cash and reduce their liquidity as opposed to using some of their equity to invest back into the project.
Okay, I'm not an
I've got a
I'm not an
memo from
underwriter.
Jim Hammernick from like 15 years ago.
My little bit of, knowledge on this comes purely from the statute, and then when we went back, I don't know if it was Paul or someone in the office went back and looked and said, well, for all the 241s we've done, there's always been a cash equity requirement. This isn't something new. Don't kill the lawyer. I'm just telling you what I'm relaying from the.
I can explain the confusion on that. In New York State, the New York Department of Health requires for their rules a 10% cash equity. So if you're looking at New York hospitals, you'll see a 10% cash equity requirement because of New York rules. But there are other deals outside of New York, if you were to look at it, and other HUD guidance. So my concern is the confusion of confusing New York or DASNY rules with a HUD rule.
I think I can speak to that some.
Okay.
We also not only had New York, but we had New Jersey, I think, in the background, because I was asked to do some of that research in there and kind of bring up the old hospitals. Also, if all the property was part of the loan to start with, because remember, we don't like carve-outs in here, then it's already part of the collateral. So therefore, then on a 241 supplemental, you'd have to have 10% equity in there because that's the only way you're going to be able to meet the equity requirement in there. If there's, so I'm like, that kind of went into the background in there too. Now, could you have carved out property in the past in here and stuff like that, and then you're using carved out property which has equity in it in here? Just at the end of the line, the 10% came down as part of the internal discussions in there. And quite frankly, on all the deals that we could research back, I actually went back, I think, like 10 years on all the 241s that I could pull up. I think actually on my computer I had them back to about 2002. I started at HUD at 2001, so I didn't have any before that. But going back to 2002, 2003, every 241 deal that we did, they'd actually put in 10% equity or greater.
Should we go back to that slide 26?
Sure. We can go back to slide 26 because I'm curious, Rod and Nikki, how you guys would interpret what your interpretation of the statute is, and I'm happy to discuss. I mean, I'm not.
I'll tell you what, I'll save this because we're going to put together a memo with some comments, and so that should go in next week. I won't wait till after this, so we'll submit that next week, and then we can follow up. Unless everybody here wants to have this conversation, but I don't think they do. So we'll do that next week.
And you and I can talk offline.
Okay, well, thanks. And what we're going to do at this moment is we're going to move into our second panel discussion at this point, and we're going to talk about the policies of how we operate. And being the government, we have a lot of policies about how we operate for a lot of what we do. And today, what we'd like to do is just bring you some clarity regarding some of the policies pertaining to loan to value, the appraisals, the timing of advances, how we treat swaps, and other mortgage costs associated with the program. So for this panel, we're going to have J.B. Nathan, John Whitehead, and Bill Williams. So the rest of you can step off if you'd like, or stay up there, that's fine. But please go right ahead and move into our next session.
Okay, let's talk. Is that on? Okay. Let's talk about the startups. And it says initial operating costs, but in fact, we're talking about working capital overall. And I point that out specifically because working capital requirements, especially for a startup hospital, involves a lot more than just the first year operating expenses. Things such as inventory, prepaid insurance, contracts that you might have with doctors for recruitment and all that will become balance sheet items that are capitalized, but will require substantial amounts of working capital. When we look at startups, and I gotta tell you on the front end, we haven't had a good history with startups, have we? Especially not lately. And I think that's just because of the nature of the industry. The industry is significantly tougher now than it ever has been before. Takes significantly more time to get provider numbers, beginning with the Medicare number and then Medicaid and so on. And all of that results in a situation where you basically need working capital for the first 6 to 12 months of operations, not the first 3 to 6 months like we might have needed 10 or 15 or 20 years ago. And quite frankly, for a hospital under 100 beds, I personally don't feel comfortable unless I've got probably something around $50 million for a startup. That is from day one through the end of the first year to allow for those provider numbers that may not come in the first 3 to 6 months and so forth. And other working capital requirements. And by the way, don't forget the MRF. I was working with a startup hospital not long ago, and a nationally renowned consulting firm had not included the MRF in the first year as a working capital requirement. And that's a significant number, as you know. All that aside, don't do them. The industry is such now that it is really, really tough to start a greenfield operation. Recruiting all those doctors that are needed and changing referral patterns with managed care companies and all those kind of things. However, we will look at any project you bring us. We have confidence in you that you're bringing us a project that is needed, first of all, and that is going to be there for the long term. But Bert Marachi is sitting in the back of the room. He's going to talk later about asset management, maybe throw in a couple of situations we've had recently. But this startup and especially the working capital requirement is very significant. I'm working with a banker now on a project they're trying to put together that will require a substantial amount of working capital, and that's the first subject that I talked about. I said, make sure that your mortgagor and all those people associated with that, including an academic medical center, make sure they understand that this is one of the most significant things that we need to talk about on the front end, and one of the most significant requirements for the success of the hospital in the first year and beyond. We've talked a little bit about the cash or letter of credit requirement. That's specifically for nonprofits. We're going to look at every deal on a case-by-case basis when it comes to a startup, especially the working capital requirements. We're going to look at a for-profit entity probably in greater detail. We might even require additional working capital for a for-profit entity because they don't have AMPO for one thing, which may be $2 or $3 million that they don't have in the project. And also, we want to make sure that whoever the investors are, whoever the owners are, whoever the partners are or whatever, that they have substantial working capital, not only for the startup, but for continued operations in terms of capital needs in future years and so forth and so on. And I'm telling you, the hospital business is not going to get any easier. I've said this before and I'll say it again. It's easier for Congress to cut money out of a hospital budget or out of Medicare or Medicaid than it is to do something with health insurance. So just keep that in mind. We have a blizzard of requirements out there now related to readmissions penalties, real money penalties, real dollars, value-based purchasing. We're going to have more and more of that going forward. So looking at a hospital has 2% margin on the bottom line, that could easily go away with just 2 or 3 of those programs that take back real dollars, and that includes the Recovery Audit Contractor Program, which is something we don't talk about a lot, but is a very profound program in terms of not only the takebacks, but their emphasis on less admissions, qualifying admissions, and that is having a profound effect on the industry now. When they talk about, well, the admissions are going down because people aren't doing this or doing that, I think the recovery audit contractors are having a profound effect on that, in that a lot of admissions that we put in the hospital just 3 or 4 years ago are no longer qualified for inpatient. They may put them in observation, which, as we all know, you lose money on, and so forth. All that being said, in our department, we have several subject matter experts that can talk with you again on the front end. Call us. Let's talk about a startup before you put a book together, and all those considerations. And again, if you have any other questions later in the day, we will be glad to entertain those questions. Next, loan to value, JB.
Loan to value, I'm going to try and be fast here because we're supposed to be out in 10 minutes. Section 242.23 does specify that you have a maximum of 90% loan to value. However, if you include swap termination costs in the mortgage, then that gets reduced to a maximum of 85%. And it's calculated according to the HUD model. I do believe that that model was actually posted on the web. Is that correct? All right. Glo's telling me yes, it was posted there. I sent it to her to be posted. It's technically a HUD inherent form and calculation in there. So in there, but on the other hand, in the I want to say transparency, in the spirit of transparency and stuff, we put it in the instructions on the web for you. So you can see exactly how we're going to calculate it. It has been a point where in the past sometimes there's been disparity between what HUD gets and what the lender community gets, and so we just thought we should be more specific on that for you. The appraisals are accepted if they're done in accordance with HUD directives. In most cases, HUD appraisals are not necessary in here. However, in some cases, if you don't meet the loan to value, the hospital's been around for several years, then an appraisal may work. You need to talk to us first because we need to approve the appraiser. You as the mortgagee have to hire the appraiser. You have to have privity of contract with the appraiser. So they are not working for the hospital, they're working for you as the mortgagee on there. Do we have an actual slide here that goes into my next slide? Okay. The handbook references in there, applicants are cautioned that one factor that HUD will consider under the underwriting will be the replacement cost, or basically to the mortgage amount, which is the loan to value in there. Obviously, a higher loan to value means that there's an increased risk to HUD in the event of an insurance claim. Historically, when I've looked at this, we seem to get about 67 cents on the dollar, after there. So obviously, the higher the amount there will affect it. I've already pointed out, if you go to the next slide, the mortgagee actually chooses and hires the appraiser. There are certain, I want to say, very minimum HUD requirements. That is, the person obviously has to be a certified appraiser. They need to have healthcare experience, including hospitals, and they need to regularly be engaged with recent hospital experience in here. Obviously, you want somebody who knows what they're doing in here, particularly when we're underwriting a $100 million loan. The lower of replacement cost, including equipment, sales comparison, and income approaches what's used. So this is a limited appraisal. We are a replacement cost program, not a market value program. And so what's going to happen is we're going to take the replacement cost, which is usually on most appraisals, the lower value, but then it's limited by the sales comparison and the market or income approaches. So if they'll come out lower, we can end up, so basically it ends up being the lower of the three values. It does use fair market value for land, because that's your basis. The land could then be used for anything. It has to be completed within 120 days of the application, and it will take the place of net book value. Net book value is a proxy. We're a replacement cost program, so once you do the appraisal's it. If it comes in lower, tough beans in there. Now, under what cases is an appraisal required? An appraisal is required if the hospital's purchased at a non-arm's length transaction in here. Then obviously you can't use purchase price then because it's there. It'll be considered if the property was acquired more than 3 years prior, And then the age, building, and depreciation result in a significant undervalue using the net book value approach. If it was actually purchased within the last 3 years in an arm's length transaction, we're just going to go by the purchase price in here. So if you just bought it last year for X number of dollars, it was a non-arm's length thing, then, you know, that's about as good as you can get, because an appraisal is an estimate. Purchase price is what the deal was.
Next short topic is the rules for the amount and timing of advances of mortgage proceeds. And to begin with, cash equity requirement the mortgagor has to provide evidence to HUD 10 days before initial endorsement that the cash equity is available in a restricted fund or account, or in the case of not-for-profits and governmental hospitals, that a letter of credit is in place for the equity. So that's something to remember as the date for initial closing approaches. And the rules for the initial advance, the maximums that can be included in the first advance are laid out there. 75% of the legal expense, 65% of the organizational expense, 75% of the consulting expense. And finally, timing of disbursement of proceeds. For a proprietary hospital, all of the equity has to be dispersed before loan proceeds. In the case of a not-for-profit or governmental hospital, once construction gets to the point where it's 75% complete, and will depend on our OAE friends to help us determine exactly when that is. But at that point, all equity funds and funds from other sources, such as grants or loans, have to be dispersed before any more of the mortgage proceeds can be dispersed. And this is something that we put in place to ensure that it helps keep the mortgage amount from growing bigger than we thought maybe it should be. So, at any rate, those are the rules for amount and timing of advances of proceeds.
Okay, swap termination cost. This is something, as Paul noted earlier, that we looked at several years ago, and over the last several years, looking at those 223F transactions that we didn't do, there were several of those that had significant swap termination cost. One in particular, I remember, had a $14 million swap termination cost. They only had 10 or 12 million in the bank, so couldn't do that deal. So that's why we put this in the new regulations for 223F. We understand that some hospitals will need some help on the swap termination cost. We can put it into a normal 223F up to 10% of the mortgage unless there's substantial construction or rehab, in which case it drops to 5% or up to $10 million. And the LTV requirement goes down to 85% if we include the swap, that 10% of the mortgage as swap costs. And we also want to make sure everybody understands that the swap has to have originated with the original financing, tax-exempt issue or whatever, and that it is a qualified hedge according to Treasury rules, and ultimately we're going to get a fairness opinion. And CFOs laugh now when I talk about fairness opinions with swaps because they don't think it's fair at all. But that aside, we will make sure that it met all the requirements for a qualified hedge and that. So with interest rates going up, maybe that's not as much of a problem going forward, but we'll see. But we have already seen at least a couple of 223F inquiries that had swap cost, and we're looking at that in detail. Okay.
And while we're talking about mortgageable costs, what's allowable in the mortgage, I call your attention to Appendix 2 of the handbook, which is allowable costs. And that's important, and probably important for you to point out to the mortgagor, because they need to know what can and cannot be included and paid for with loan proceeds when they're preparing their plans, their budgets, and applications for mortgage insurance. A couple examples, just picked out at random. The mortgagor's costs in fundraising for the equity portion, and things like awareness campaigns and grand openings. Those are not includable in the loan. You'd think maybe they should be, but they're not, and the mortgagor needs to know that. Another one, bonus payments to contractors for any reason. That's another one that may not be included. Now, something that can be included, and this kind of ties in with the swap termination issue, the cost of retiring the debt to be refinanced may be included in the mortgage. So if you have prepayment penalties or prepayment premiums or defeasance costs for the old bonds, those are includable. And unlike the swap termination costs, there are no limits in terms of, loan to value or percentage of loan or what have you. However, a warning, once you start adding these costs to the mortgage, you can find, if they're significant, you can find that maybe it's not going to pass underwriting anymore. So that's the danger. But they can be included. And that's it on mortgageable costs. Insurance.
Last but not least is the appendix on insurance that's in the new handbook. We talked with John and others, including servicers, and what we found out was that insurance is really not defined in terms of our requirements or the servicer requirements. So we felt compelled to include this chapter in the handbook, and it basically outlines the minimum requirements, such as $1 million, $3 million on a standard malpractice policy and that kind of thing. So I would suggest to you that you take these as minimums, and most hospitals that have cash flow will almost always have the appropriate coverages. But when cash flow is tight, they start increasing those deductibles. They might drop D&O, they might do this, they might do that. So watch out for that. And also, I think this is guidance to the servicers, because they're primarily responsible for collecting those monies as they do what they do, and then pay the renewals for those policies when they come up. We don't want any of that refinanced. And again, that gets into hospitals with cash flow problems. If they have cash flow problems, all of a sudden refinancing that $500,000 malpractice policy looks attractive, even though it may be a 6 or 7 or 8% interest rate. So watch out for that as well. We also talk about some of those miscellaneous items in there, such as earthquakes and tornadoes and floods and such. And it seems like that's happening more and more. So I would suggest to you that you look at those requirements and think about those requirements, because if they're needed, they're needed. I understand the costs may be significant, like in California for earthquake and that, but hey, if they're sitting on a fault line in California and it's a $200 million project, they probably should have that insurance. And I'm a big believer in having a business continuation insurance as well, which we don't require, but it is a good thing to have, especially if you're in flood zone, potential flood zone, Tornado Alley in Oklahoma, as Moore, Oklahoma was, or Joplin, Missouri. All that aside, I think it's incumbent upon the bankers initially to look at that and think about those risks. And Catherine, back in the back of the room somewhere, thinks about those risks that maybe sometimes we don't think that much about. But that is a significant risk if we've got a mortgage outstanding in certain parts of the country. Insurance obviously should be according to industry standard. But we will also accept a captive insurance company if an organization that's large enough and has enough cash flow to do their own captive. That's okay. If they're doing it in conjunction with other hospitals or with the State Hospital Association or whatever. But in those cases, we will definitely make sure that an independent actuary has looked at that, and an independent insurance consultant has looked at all that, and we will pour over those financials to make sure that, again, speaking of Catherine, that there's no substantial risk in that arena, which can certainly occur. I've seen, in my 30-year career, I've seen insurance companies, local captive insurance companies associated with groups of hospitals or even a hospital association go belly up, when things go bad in that arena. So take a look at those requirements. And I think we're done.
Thank you, Crew. Thank you. So it's lunchtime. Our target time back here is 1:30. So right across this courtyard is a gigantic food court. So if you want to find lunch, just go out the back doors over here and straight across. A lot of lunch items over there. See you at 1:30. Thank you.